Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast, available every morning on Apple, Spotify or wherever you listen. It's Thursday the 15th of February here in London. I'm Caroline Hepker.
And I'm Tom Mackenzie. Coming up today, Britain falls into a technical recession as the economy shrank at the end of last year.
Israel quits ceasefire negotiations as fears grow about its new Gaza offensive.
Plus, Vladimir Putin says Joe Biden would be a better US president for Russia.
Let's start with a roundup of our top stories.
Britain fell into a technical recession in the second half of 2023. GDP shrank 0.3% in the fourth quarter, pushing the UK into a shallow economic dip. But Bloomberg's UK correspondent Lizzie Burden says the milestone isn't a major worsening of the economic picture.
A toxic headline, but stagnation, recession, it doesn't feel much different to your average Brit, and it's a bit tomato for the Bank of England. Yes, weak growth makes the case to cut rates sooner, but as Andrew Bailey, the governor, said yesterday at the Lords Economic Affairs Committee, he's still concerned about wage growth and services inflation.
Burden added all three sectors of the economy shrank in the final quarter. Services contracted 0.2%, production by 1% and construction 1.3%, showing the downturn was broad-based. The pound slipped against the dollar after the release. It traded as much as 0.1% weaker at 125.48, set for a third day of losses, currently trading at 125.44, down 0.2%.
Well, Japan also unexpectedly slipped into a recession last year after GDP contracted at an annualised rate of 0.4% in the fourth quarter. The weaker than expected result will complicate the Bank of Japan's case for its first rate hike since 2007. Only 1 out of 34 economists surveyed by Bloomberg had expected a contraction in the quarter for Japan. It also means that Germany overtakes Japan to become the world's third largest economy.
Now, Israel's Prime Minister Benjamin Netanyahu has broken off Gaza ceasefire talks, calling Hamas's demands delusional. The Iran-backed group wants the total withdrawal of Israeli troops from Gaza before it releases hostages. It comes as key allies urge Israel not to go ahead with a planned offensive in the southern part of the Strip, with more than 1 million Palestinians sheltering in Rafah. Canadian Prime Minister Justin Trudeau is one of the leaders advising restraint.
The situation right now in Gaza and in the Middle East in general is dire, and the extra pressures of the threats to more action on Rafah has everyone deeply worried. We need to see stabilization in the region, peace, and we need to work on the two-state solution. That is the only way to ensure durable peace and safety.
Despite Trudeau's words, Netanyahu had initially refused to send an Israeli delegation to the talks at all, but eventually agreed to do so following pressure from US President Joe Biden.
Well, Vladimir Putin says that Biden would be a more experienced, predictable leader than Donald Trump. Here is the Russian president speaking to state television about who would be the better US president for Russia. We've added a translator.
Biden. He is the more experienced person. He is predictable. He is a politician of the old formation. But we will work with any U.S. leader who the American people have confidence in.
Back in 2016, Putin publicly praised the other frontrunner, Donald Trump. The former president is now campaigning to turn military aid to Ukraine into a loan and scale back America's NATO commitments.
One of the heads of the country stood up and said, does that mean that if we don't pay the bills, that you're not going to protect us? I said, that's exactly what it means. Exactly. I'm not going to protect you.
Donald Trump's comments, which have rattled leaders in NATO. European defence company shares, though, rose yesterday after the military alliance said that a record 18 out of the organisation's 31 members would meet the goal of spending 2% of GDP on defence.
Now, Airbus says it is planning to deliver 800 aircraft this year, pushing output of its A320 family of planes and widening the gap with rival Boeing, stuck in crisis mode, of course. The European plane maker gave the target as it reported its results for the full year, with adjusted earnings before interest and tax of €5.8 billion on revenue of €65.4 billion. Airbus is also planning a €1 per share special dividend on top of its regular dividend.
And finally, at least one person has been killed and more than 20 others wounded after a shooting at a parade in Kansas City celebrating the winners of the US Super Bowl. Thousands of people were on the streets of the city at the time, and the injured included children. 3 people, including 2 who were armed, have been detained. Quentin Lucas, the mayor of Kansas City, paid tribute to the emergency services.
As I was leaving the scene, I saw members of our Kansas City Fire Department administering aid to folks who were seriously injured without concern for the shootings and the challenges that were near them. This is absolutely a tragedy, the likes of which we would have never expected in Kansas City.
That was Kansas City Mayor Quentin Lucas. President Biden has called for a ban on assault weapons following the shooting. And those are our top stories. Well, in a moment, we'll dig into the UK GDP data, the UK falling into recession, that with our UK correspondent Lizzie Burden shortly, plus the 13F filings, of course, from the US yesterday. But this story also caught our eye, and it's sort of worth a mention. Bloomberg opinion columnist Julie Wren, who always writes really great pieces, she's been delving into the Cathie Wood story, and she's got a nice chart, actually, of the relative performance of Cathie Wood's ETF, and actually it's not very good. There has been wealth destruction basically over the last decade, $14 billion in shareholder value in the past decade. But she points out that investors have largely stuck by Cathie Wood. There haven't been many outflows, and she writes that that's because Cathie Wood is a great storyteller and a kind of great advocate for her ideas, and that perhaps this is something that other money managers need to think about, that it's sort of the selling the idea and the concept, if you're a star investor, to the investor.
I've interviewed her. She's very, very compelling indeed. She has that conviction. Tesla was, of course, a key win for her. She bet on that company in 2018. That did very well for her. She had record inflows and record performance during the pandemic, of course, when so much money was poured into those tech companies. But it has been a rough ride, of course, for Wood and for her ETF in the subsequent kind of 18 months or so.
Yeah, and it's that whole debate around like a star money manager, star investor, star funds, whether you buy into that story or not. Anyway, it's a great piece, so I advise having a look at it. Julie Wren writing about it on the Bloomberg terminal. Meanwhile, let's go back then to the UK story, shall we?
Let's bring in Lizzie Burden then, of course, who covers all things UK for us here on Bloomberg Radio and Bloomberg TV. Lizzie, your reaction then to the data. We can confirm it. The UK is in recession. Talk us through what we've been seeing on the numbers.
Well, if you break it down, you've got services, construction and productivity activity all falling. It's a toxic headline that there's a recession in the UK, but the difference between stagnation and recession isn't a big one. It doesn't feel much different for your average Brit. It's all much of a muchness for the Bank of England. The governor yesterday was just talking about how the narrative is no growth. So yes, weak growth makes the case to cut rates sooner, but as Andrew Bailey said yesterday, he's still concerned about high wage growth, services inflation, and from what he also said, it doesn't look like more hikes are on the way. At least he's reiterated that the question's not how much more restrictive the bank needs to be, but how long rates need to stay restrictive for. I would just point out it's an unusual recession, this, because you've still got 900,000 vacancies. You've got a 2-year high in consumer confidence. So while Andrew Bailey wasn't doing cartwheels over the inflation data yesterday, he's not likely to be crying over this.
What else did Bailey talk about yesterday? Because he spent quite a long time with the House of Lords Economic Affairs Committee, sort of talking through all of the UK's various issues. Yeah, he was talking partly about inflation and where it leaves the Bank of England, but also he came on to talk about nerdier topics that you like, Caroline, I know, like quantitative tightening. Yes. He said that changing the quantitative tightening programme to save money for the taxpayer would effectively be a tax on the banks. Now, this has been really controversial. How do you come out of this tool when actually the Treasury is footing the bill? But we had Dan Hansen come in to talk about this. It's an incredibly difficult topic to talk about when actually the main thing the Bank of England wants to do is prioritise interest rates as the active tool. Yeah, the revelation that basically once you start selling off a Bank of England assets, it's realised losses, and that's a loss for the taxpayer. So I think it's quite interesting that Bailey was sort of defending himself against, or defending the bank against, those concerns about the hit to the taxpayer.
Talk us through the market reaction then to the GDP, to the fact that we are now in a technical recession. I'm looking at gilts, for example, yields down 4 to 5 basis points across the curve. So there is some action there.
Yeah, that's the gilt story. The pound's taken a leg lower, though not spectacularly. The FTSE's higher, and that strength in stocks and the weakness in the pound suggests that traders are getting back on the rate cut bandwagon again. And indeed, if you look at the pricing for BOE rate cuts off the back of this print, they're fully back to pricing 3/4 point cuts in 2024.
Yeah, and it's the backward-looking data, isn't it? So very interesting. Lizzie, thank you so much for being with us. Our UK correspondent, Lizzie Burden.
OK, let's get to another intriguing story. It is, of course, that time of the year when we get 13F filings, which in shorthand is a way for us to look at how some of the big money managers, hedge funds notably, are lining up their bets, or have been lining up their bets. Here to discuss, there's been a focus on big tech, there's been a focus on AI, probably not a huge surprise there, but it does tell us a lot about sentiment, certainly on Wall Street. Let's bring in Charlie Wells then, who's been lifting the hood on these 13F filings for us. The theme does seem to be the smart money is also flowing into AI. Talk us through what we've been seeing.
Yeah, so Bloomberg has analyzed 835 13F filings. So that's a lot for hedge funds. That's just for hedge funds. And yes, that is correct. It really is all about the AI trend, as well as kind of a interest again in big tech. And the big add here was Amazon. So $22 billion worth of shares added by hedge funds in the fourth quarter, as well as Intel, as well as NVIDIA. But it's important to remember, of course, that these are backward looking, right? These are for the fourth quarter. They're required to be reported to the SEC 45 days after the end of the quarter. But still, they give us a sense that this smart money was really looking into tech.
Yes. Okay. So AI is the theme. They also show, though, what positions hedge funds left, what they exited. So what's kind of out, or what was out in the fourth quarter?
Yeah, that's good to remember. And I think it kind of complexifies the big tech story, because we saw, net $6.6 million of shares dropped from Meta. And so that seems to be potentially some profit taking on the tech side. Interestingly, some other drops were Nike. So we'll remember, I think I'm pronouncing that in the very American way. But, Nike had a bad 2023. There was this talk of the end of the sneaker bubble, a kind of glut of inventory. So that seemed to fall out of favor with hedge fund managers, as well as Pfizer, right? The pandemic in very much the rearview mirror at this point. So those were two notable drops.
Anything that when we're thinking about the economy and how the economy is evolving, we're seeing, of course, the relative resilience in the US. We're in recession here in the UK. Japan's in recession. China has its own challenges. What can we draw? What can we learn from the way that hedge fund managers are thinking and putting place in their bets? What does that inform? How does that inform the story around the economy?
Yeah, so they seem to be positioning themselves in a way that was very tech-oriented, as we talked about. So, the largest holding in these portfolios was tech, 25%. But then when you look at the second largest category, it was consumer discretionary. And to me, that seems like a positive story, at least for the U.S. economy, that maybe there is this sense that the consumer will continue to spend on some of these discretionary items, which we've seen again and again and again over the past few years, of that consumer just showing up.
Things that we'd like to have, but don't necessarily need.
Yes, that's right.
Indication. Okay, so then that's on the kind of economy front. I suppose what else stood out to you in the 13F filings? As you say, there are just so many of them.
Well, what's fun is you can see where some of these kind of big stock pickers, these kind of contrarian personalities have, made choices. And I think Michael Burry is a big one, famous from The Big Short for betting against the U.S. housing market. Interestingly, he took in the fourth quarter a contrarian take on China. So the largest holding at Scion Asset Management, his hedge fund, was Alibaba. The second largest was JD.com. We know those have not been loved by investors recently. Alibaba down about 5% so far this year. JD.com worse, down about 20%. So that certainly is a contrarian take. And then Warren Buffett, he's always one that's interesting to look at in these filings, trimmed a little bit of his Apple holding there. So adding some of the complexity to kind of how big investors sort of reshaping their thinking on tech.